realistically, this sounds trite, but in this environment, you shouldn't be doom and gloom, but you absolutely must be cautious. And you need to do more work than you've ever done, whether you're underwriting a loan for your balance sheet, underwriting loans to putting in deals, because you can be darn sure that to the good, our investors, these institutional investors are super, super smart. They do a ton of work on each of these deals. So they're doing sort of the re-underwriting on the other side. And so I do think that one of the things we all learned, GFC, people were just waving in, loans to close and then bonds to buy.
Hi, Adam Gower here, founder of Gower Crowd and host of this podcast and YouTube series, Real Estate Market Watch, current events through a real estate lens, where I am trying to unwrap the uncertainty that is swirling through the market at the moment by speaking to some of the industry's top experts. And my guest today is Lisa Pendergast, who is the CEO of the Commercial Real Estate Finance Council, or CREFC, which represents the institutions that provide, manage, and invest in commercial real estate debt. These include banks, insurance companies, CMBS issuers, and other structured credit investors. But before we dive in, it's important to understand the perspective that Lisa brings to today's conversation. Now, while many of you may be real estate sponsors, operators, or individual investors focused on raising equity, managing properties, or investing alongside sponsors, Lisa's vantage point is different. She speaks from the institutional capital market side of the industry, where the focus is on managing credit risk, ensuring liquidity, navigating regulation, and understanding the broader flow of debt capital. Her insights reflect the perspective of those who underwrite, trade, and invest in commercial real estate loans and securities, not the ones raising equity or sourcing deals, but the ones making the debt markets function. For example, Lisa discusses conduit and SASB loans, which refer to how commercial real estate debt is packaged and sold to institutional investors. Conduit loans are pooled together from many smaller properties and borrowers, offering diversification. SASB loans, or single asset, single borrower loans, are large customized loans backed by one major property or portfolio. Now, in Lisa's world, investors are the institutional buyers of these securities, like banks, insurance firms, and asset managers, who assess and price real estate risk across portfolios. So why does this matter to sponsors or their limited partner investors? Well, because institutional investor appetite for these bond structures directly affects how much capital is available and what it costs. When demand softens, lenders tighten credit, meaning they get more selective, raise underwriting standards, pull back from certain markets, or lower the amount that they are willing to lend. That means that sponsors may need to bring more equity to the table or face higher interest rates, as well as having to meet stricter terms to qualify for a loan in the first instance. In short, Lisa's insights help explain the capital market forces upstream that shape the terms and availability of financing downstream, the kind of financing that you're probably more used to, which is where deals get made. Okay, if you've not signed up to the accompanying newsletter for this podcast series, please go to gowercrowd.com. There's a big subscribe button there. Hit that link and subscribe. It's completely free, and I am producing these podcasts with some commentary for the newsletter. So it's not going out on a regular basis, but I will be releasing new newsletters as and when I record these podcasts. Okay, that's it. Let's get on with our conversation with Lisa Pendergast, who is CEO of the Commercial Real Estate Finance Council. Here she is. Lisa, thank you so much for joining me. It's an enormous pleasure and privilege to have you on the show. Thank you. Why don't we start, if you wouldn't mind, please tell me a little about your background and also what the Commercial Real Estate Council, or CREFC, is and its role in the industry.
Fantastic. Thank you for having me. This is going to be fun. I had fun, sort of just thinking about what we're chatting regarding today, and there's so much to talk about. So I appreciate the conversation. Thank you. How I got started. Let's see. I graduated from college in 1983, wanted to go to law school, couldn't afford it. Started working in the financial markets, mostly for more consumer related at Merrill Lynch,
Mhm.
and did that for a little bit, where I wrote stories about various sort of strategies for, financing your retirement and the like. That was not something fun for me. So when I went to Prue Securities, I found a job there in the financial strategies group, where a lot of the folks that were hired to develop things like stochastic analysis and how to develop option adjusted spreads on mortgage pass-throughs. Some of them, English was not their first language. So literally, I was thrown into their offices and they would talk and I would write. And it was in many ways the cheapest MBA that any person has ever received. So to me, that was always a win. I never did go to get to graduate school because I just fell in love with the business and did the research thing for quite a number of years, from really 1983 to, or 80, no, 86 to 2016, when I
Wow.
took this job at the Commercial Real Estate Finance Council. At some point, you have to stop writing weekly reports for decades. It's just, it's a little much after a while. So anyway, I'm enjoying my work at the Commercial Real Estate Finance Council. It allows me to do two things that I truly love, and that's dig deep into the commercial real estate finance space, but also something that I only got a touch to do, which is to speak to our congressmen, senators, House, Senate, as well as regulators, as to where this business is, where we might need help, where we think some of their either legislative or regulatory actions have perhaps not been quite on the mark. So what problem are you solving, and are we in fact solving that problem by the methodology that's in place today? So it was that. And so those two things together have made this a super, super fun job for me, not to mention most of our members. I can't say I know, there's tens of thousands of them, but most of the members I know. And from at least if I don't know them, I know who they work for or who their friends are. And so that makes it a lot of fun. And what it also does, though, from a work perspective and a efficiency perspective, is I have a Rolodex where I can call almost any one of our members, ask a question, get a wonderful answer, and people take it seriously. And it is a great, in my mind, it's a very operationally focused trade association where we take people to the hill, members of our board. We have a fairly large board. I think this year we're going from 52 to 47 because we just couldn't fit everybody in a room anymore. But so yeah, long story, but that's where we are today.
Well, let's lean into some of the insights that you're learning at CREFC. And I'd like to start with, so in preparation for this conversation, I listened to some of your prior podcasts. And there was one very interesting one where you were talking about the ebullience of sentiment in Q4 2024 in the Board of Governors Sentiment Survey. And then, of course, we see the Q1 Sentiment Survey, which is diametrically different. So can you talk about that? First of all, maybe start with a summary of how sentiment has changed in the first quarter over Q4 last year. And what is driving that change, do you think?
Sure. There are a variety of things that are changing, that are causing that shift. Much of that certainly has to do with, sort of the shift from a Biden administration to a Trump administration. The second is also, where are we going on the rate sort of situation? I don't blame the Fed for not moving, because the data is sort of all over the place. It's liquid for sure. And yet at this sort of in this sort of environment, with the Fed not moving, with there being significant uncertainty in markets in DC, both with regulators and legislators, then you say to yourself, as well as obviously the White House, the uncertainty is quite significant. And when there's uncertainty, my understanding, like, again, decades sitting on a trading floor, is that things just stop. There's no one who wants to step in front of that train, either on the buy side or the sell side as it relates to the securities market, but also in committing to doing large loans in a current environment. If you're a borrower, your thoughts are, who knows where this is going? If I can get a lower rate, in 6 months, I'll wait. If you can. If you can't, that's something different. If you have a maturing loan that you need to refinance, you need to kind of pull the trigger. But I do think that right now the uncertainty in the market is really casting a pall across the ability to originate loans, to buy bonds backed by those loans. From a servicing perspective, folks have been very, very busy just trying to keep a lot of loans afloat right now, and we'll talk about it more specifically, but the delta between where these maturing loans were done from a rate perspective and today is 300-400 basis points. And that's, a challenge, even if the cash flow on your property hasn't changed. And in many cases, we've seen some degradation. In other cases, we've seen increases. But generally speaking, depending on the asset class, like an office, clearly there are issues there. And so trying to refinance an office property, assuming that it hasn't changed, you should be able to get it done. It's money in some cases, depending on valuations from a borrower perspective, but it can get done. It's just everyday sort of $15-20 million loan, could struggle trying to, kind of make the nut that's today's much higher mortgage rate.
It's not just interest rates, is it? There's a lot of cost factors.
Cap rates as well. So the double whammy, and I'm sorry to interrupt you, but it's the double whammy of the mortgage rate being higher, cap rate being higher, so your valuations are lower. And in that situation, those two combinations are going to get you less proceeds, which means you may not be able to pay off the existing mortgage based on the refinancing, which means money in from the borrower. And then you have a borrower, sort of questioning, do I want to put more money into this asset? Do I feel like it's going to pay off? Is it going to neutralize? Whatever. Those are the questions that it feels like lots of sectors of this market are now faced with some very difficult decisions on how to move forward.
Yeah, and a clear indicator of that. It's like catching a falling sword. I remember that term coming out of the GFC. The latest data, and again, I looked at CREFC's data, but it's changing all the time so quickly. CMBS delinquencies have surged to over 7% in April, the highest level since 2021, and multifamily delinquencies are nearly 5 times what they were a year ago. So what are you seeing in terms of these trends, and how do you interpret what's happening and where we're headed?
I think there are two different sort of sectors there in terms of, office. It's pretty obvious what some of those office properties are experiencing, and that's losing in many ways tenancy to the extent that you have larger, newer office assets out there. You're sitting in something that was built in the 30s, and renovated, but still built in the 30s. You're going to look to either, if you can, move out of your current space into something that's better and cheaper. Now, you have to do the math there because it's going to cost you if you have a 10-year lease and you're 3 years in. But to the extent that these are some of the decisions, and they also are seeing folks just trade up. We're in a great asset, but maybe we can get an even better asset, and it's better for retention. If you're concerned about, work from home issues, if you can create an environment that's truly spectacular, maybe people will more often come to the office. So I think there's that. On the multifamily side, in many markets, you are seeing sort of a glut of new supply. And so that's certainly one of the issues. And I do think from a multifamily perspective, you have, the GSEs making the majority of the loans, Fannie and Freddie. For a long time, I also was involved in the Ginnie Mae project loan market. And to me, just as an aside, I always feel if we could build that market into something more institutionally focused, that you would have the perfect affordable mortgage, for 35, 40-year fully amortizing loans. And I don't think it's always the easiest loan to close, but they're doable. And so to the extent that was a sector I always thought was a little underserved, and frankly, been talking to the Fed on community development financial institutions to see if they potentially can't securitize those CDFI loans, but also maybe think about focusing more on developing that GMA project loan market further. It's always been a little bit of a second ran, and yet I think in the current environment where affordability is such an issue, it can be helpful. So kind of went off the tracks there, but
no problem actually. But it brings me back to a question that I was going to ask, totally out of sequence there. So, what are the biggest challenges that the Fed is facing today? Like, how are they? It's a big question, obviously, but what are they dealing with, and what are you seeing on that hill?
They're between a rock and a hard place. And I think it's not just about tariffs and potential inflationary, sort of issues that may result. But it's also, I think about just the significant uncertainty in the market. You could have a stagflationary environment potentially, which would negatively, it's like kind of a double negative for commercial real estate and commercial real estate finance. And so, I do think the Fed is in a tough spot here. I do think that they need more dramatic data to pick a side and move forward with that. And, I think there is a lot of sort of pressure, if you will, coming from the White House in terms of what it is that they do. So I think this will also be quite an interesting sort of tug of war, if you will, as we move forward and we see how the Fed behaves and, the pressure that they get from, the White House to move. I think they're very independent, and I don't think they can be pressured to that extent. And so they'll move when I think they feel that they should. It's just this crosswinds, right? The crosswinds right now of concerns about inflation and concerns at the same time about recession. And, recently I was I had another podcast, and the question was supposed to be asked that was never asked, was what about stagflation? And I think of any time that I can think of in the last 30, 40 years of my being in this market, it struck me that this is sort of the perfect storm for that. And we could see that. And, from the perspective of this commercial real estate loans, as I mentioned, it's not helpful because, again, if you have loans that are 3.5%, 4.5% that need to get refinanced in the 7% area, that's a tough nut. And so to the extent that it's up to the Fed to find, I hope, opportunities where maybe they can kind of come in and do some easing without overdoing it, that would be very helpful. And I know that they're getting pressure from folks to do that, but they too are worried about, well, we're going to just turn around and just fan inflation further, and we have to turn around and do the other thing, right? So that pivot, it certainly reduces any kind of confidence in the Fed itself, and not to mention it creates havocs in markets and in hard assets like commercial real estate.
What signals are they primarily looking for, do you think, Lisa? And
the Fed?
Yeah, and how long is it going to take before they see any kind of clarity?
I think that the signal that they would like, I think that the inflation stuff, they're good. They understand where that is. And I don't think they're pleased. I don't think it's desperate. I do think it's probably the one thing that's most surprising is that the economy is kind of held in here. And you would think that enough has happened that maybe it wouldn't. And so I do think that's one of the real enigmas for the Fed is, so is this real? How long can this continue to sustain itself? And the reality is that when you talk to people, no one seems super concerned about sort of any kind of real downturn in the economy. One, and then I do think I hear more about rates, right? And, I think there's a real opportunity. There's a dog walking behind me. That the Fed is going to stay on hold until they get a clear message of where they need to pivot. And I don't blame them for not moving because it's one of the most precarious situations we've been in a very long time. Well, and there are billions of loans that need to be addressed beyond commercial real estate.
Okay, so that actually ties directly or segues beautifully into my next question, which is, all right, so you are tenured in this industry. You go by back
A
only.
nice way of saying you're an old gal in the business. Okay.
I actually tried to find the right word. I spent a little time trying to find the right word. I didn't want to say anything like that. So, but your tenure in the industry, you've been in this industry for a long time. In the sense of having seen other downturns.
Yeah.
So, of course, this is kind of the classic question. Is this time different? And in what way is it different from other downturns? You started in the industry pre-savings and loan crisis,
Actually, just around SNL. Yeah.
just
Yeah.
around SNL. That was my entry point as well. I
Fun.
started about 8 years before that kicked in. Uh, and um, and then also, of course, the global financial crisis. So what are we looking at today relative to this? What can we learn from those times today, or is it really different today?
I think what we've already made some, we've done some learning, let's put it that way. GFC highlighted that pro forma underwriting and
Mm,
sort of hope notes and all of the things that sort of made the GFC, unfortunately. Um, I really believe, and maybe I'm sounding a bit Pollyanna here, but that the market has, especially in the CMBS space, has done a remarkable job of doing their very best to do the right thing. Um, so you're not seeing a lot of pro forma. You're seeing very thoughtful underwriting and lending. Um, I think probably the biggest challenge in the current environment is what we haven't always had to face, sometimes we have, is the uncertainty surrounding sort of office demand, the uncertainty on this whole sort of migration toward multifamily is, as we've seen more, just more of it over the decades now, and certainly over the last decade, there seems to be more demand for multifamily housing from all sorts of folks, from folks that are getting out of college to people like myself who lives in an apartment and now because who wants to deal with a house. But,
mm,
so to the extent that that demand has changed in the multifamily space, I think the other thing is I feel like I've spent my entire research life, that's about, like I said, many decades, writing about dead malls.
dead
I would
loan.
argue that dead
Mm.
malls,
Oh,
they
dead
still,
malls. Yeah.
but they're scattered. They aren't the
Mm.
tsunami they were, where honestly, it was at some point you're like, okay, another mall. That just, and you would track it for 5 years, six
Mm.
years, and waiting for it to kind of shift. And so, I do think that from that perspective, um, the asset classes within commercial real estate seem to have stabilized a bit. Um, I'm starting to see some more activity on the retail front, on the mall front, that I think the more sort of new age retail seems to be at least more stable in many ways, depending on you put the right thing in the right place is important, right? But to the extent that, malls aren't what they were back then. And I think we found a way of that work, live, play kind of scenario around malls. It's not a panacea, but it's certainly a better sort of platform, if you will, to make sure that they continue to move forward. And just in time sort of inventory issues and things like that. I sat through a recent session where folks were just, recognizing that a lot of these stores, you go into a Nordstrom's, try to find something in every size. You can't find that, right? But immediately it'll get to your home a day later, right? And you order it in the store. Um, that type of efficiency in retail is interesting. And then I think, from an office perspective as well, there's a
Mm.
whole new scenario there in terms of you need to make, during COVID, we were walking around Manhattan and we secured a 10-year lease on a lovely SL Green building, and it's spectacular. And the young people that work in our offices are thrilled, super, super happy. And so there is this sort of movement to sort of, in many ways, skinnying down, but making whatever that experience is better and more palpable in terms of either your tenancy or, from my perspective, my employees. I'm happy.
Yeah, so the idea that am looking to explore a little bit in terms of this time is different is that in prior downturns, what has come out of them, particularly global financial crisis, were guardrails, regulation that closed, areas of excess that
Mhm.
are now, it appears, being deregulated. Again, it's as though we're stepping backwards to take these guardrails off. How do you interpret that? How do you handle those discussions when you're on the Hill or with your members? These were protections like Dodd-Frank's and the Volcker rule, etc. The elimination or dismantling of CFPB recently. So
Right.
what I mean, it's fabulous, right? Because it means that we can enjoy an exuberant future in real estate again. But on the other hand, they were put there
It's always the other side to that, yes.
to restrain the excesses that almost created systemic collapse. So what's going on?
I think on the regulatory front, Dodd-Frank is still doing exactly what it was intended to do. And I
Which
think
was what? Just clarify that in 101
I think
language, if you will.
it was meant to one, just reduce the exuberance that was in that market, and that obviously came to a crashing halt. And it did sort of many of the things in terms of, double dealing. Were you doing anything? Conflict of interest rules too were important. There's a lot more that's out there from discussions regarding deregulation. I'm just not sure that you're going to see it unless it's really. We haven't seen anything in my mind to suggest that some of these major rules, like Volcker, is going to be turned around. And I actually, the one thing I will say to counter to that is that one really positive thing, potentially coming out of the Trump administration, is the fact that he gets now to appoint the heads of the various regulatory bodies. And my understanding always, and I've approached this way consistently. We know that regulators are trying to do the best that they can for whatever markets they serve. To the extent that there were rules under the Biden administration where it had a lot to do as to who is the head of those agencies. And what's unfortunate is that, so there's a Democrat in the White House, you have Democratic regulators. There's a Trump in the White House, a Republican, you have Republican regulators. To some extent, there's a certain sort of central point, where they all agree. However, there were things during the Biden administration that I would argue didn't make a lot of sense. Or more importantly, what is the issue that you're fixing? What is the problem? And does this fix it? And oftentimes the problem wasn't necessarily stated, except at a very high level. And we spent, months and months and months, if not years, on certain things where you say to yourself, I don't know what problem this is fixing. Now, it could be, so that's one risk to have, saying, is there something wrong that needs to be fixed? And a lot of the things that we found were just not all of that sort of, it's really about sort of certain deregulation things. I think you mentioned, there was Volcker. What was the other one you mentioned? It was Volcker
Dodd-Frank's.
and Dodd-Frank. Yeah,
Yeah.
that one. I mean, ultimately, Dodd-Frank, while I think we kind of all kicked and screamed saying things are changes and these are going to work. And, it added some extra steps to the process, but I think ultimately it did what it was meant to do. And that's to prevent sort of the overreach that we saw leading up to the GFC, pro forma underwriting and things like that, that it just put a sort of a bee in everyone's bonnet to say, be careful, tread lightly, don't do this again. And we're watching. And it does take some time. And I think what's unfortunate is, depending on who's in the White House, who's in the House and the Senate, those regulatory sort of requirements really shift from one administration to the other. And when you have a Democrat and then a Republican, and it goes back and forth, it doesn't make for sort of easy government. And it certainly doesn't make for easy government from those on the receiving end who are trying to track this, right? So I suspect under, the Trump administration, we'll see some softening of different things that are out there. There's something called a SEC Rule 15C211. And, that really was, in my mind, not a lot of, it was kind of silly. So basically it wanted to have private bonds be reported as public bonds. And it just sort of mixed metaphors there. And, everyone's well-intentioned. So my interest wasn't to sort of ding anyone here and say, this is not, everyone's trying to do the right thing, usually. And yet there were certain rules where you just say, there was the Rule 192, which was a conflict of interest rule, which also didn't make a lot of sense. So there have been a couple of things that under sort of a different administration, we felt there was overreach in terms of trying to fix problems that weren't in need of fixing, or issues that were not in need of fixing. And so we'll see how that works. It could backfire as well. And, so we know that, President Trump has made, various, new heads of various agencies. Pulte is certainly one of them, as head of FHFA. I believe he has sort of thoughts similar to Calabria, which is that they should be, removed and put into their normal place in the world. So, conservatorship to me was never meant to be this long. And so the question is why, and I do believe that if you're worried about housing and housing affordability issues, the ability of, Fannie and Freddie to move forward in a very positive way would be positive for the country and positive for housing, if you will. It's not like they're not doing it. I mean, nothing in many ways has changed in what they're producing. It's just that the sort of transparency that you would expect isn't always there. And they're very good about many different things, but sort of plans in terms of what is your sort of, if you will, game plan as we move forward in this market? How are you going to focus on affordable housing? And what else do you do within Ginnie Fannie and, or Fannie and Freddie? And what does that, when do you ever, exit from conservatorship at some point? It's sort of silly to say we're fixed, but we're still in conservatorship and it's been going on for, forever.
Okay, so let's elevate to 50,000 feet, right? So these are all very localized or domestic considerations, but from overseas, they see something very different. And overseas is very important because of the exorbitant, what has been come to be known as the exorbitant privilege of the US dollar, our ability to lend at extremely low interest rates that really drives the economy. There appears to be a loss of confidence or a trend towards a loss of confidence in US governance, in the US economy overall. Including, I mentioned this Reuters article this morning that talks about a very substantial shift away from the dollar in Asia. But also with discussions in Congress about the elimination of the debt ceiling, for example, right? as Lisa rolls her eyes as I mention that. So this, particularly if these things are reducing foreign participation in U.S. Treasury auctions, getting some little more detail here, that could potentially increase borrowing costs by increasing interest rates. That's kind of the big picture I'm trying to get at. That's my doom and gloom perspective, Lisa, seriously. What's your take on what's going on?
I mean, sitting here and not sitting across the pond, there are things that come over the tape and you say, what are we trying to do here? We're not in any way fanning sort of, some level of confidence in what's happening here. I mean, certainly I hope that things settle down and we, find our way. I do think
that you know what they say. I'm going to cut you up. They say hope is not a strategy, as they say.
No, it's not a strategy. No. So but the question would be, what is the strategy if the tone doesn't sort of settle down,
Mm.
right?
And what are
It's
the
about,
implications as well? What are the implications if
it's the uncertainty and the willingness, therefore, to buy treasury bonds, to buy, some basic things I think could potentially be impacted by those who are looking from abroad into the US to say things need to set. My view, it
Mm.
all needs to settle down. The tariff issue, it's bring it up a year from now. Settle in. Let's figure out where, the important things that we must do today, and then move on to think about, whatever you want to do on the tariff front. Let's have real conversations. Let's not alienate friends from others, in other countries. It doesn't help, especially when we are such a large importing company.
Right. So this idea of a decline or drop in confidence of in the dollar, in the US, in US governance, in the uncertainty that's being developed, etc. Are you seeing any signs of that? And I want to be careful not to put words into your mouth or even
Yes.
suggest I have an answer already. But are you seeing any trends yet in CMBS spreads that might be suggesting there is already an impact? And what do CMBS spreads tell us about the overall health of the commercial real estate industry?
Yeah, I think the spread market has really held up pretty decently so far. At the end of the day, if you think about where where are the pain points in that, it has less to do with the ability to buy CMBS bonds at some spread and yield. But I do think there's this concern regarding the volatility and whether or not you buy a bond, say you buy a AAA bond, I don't know, let's make up a spread at 100 basis points off the 10-year swap.
Mm-hmm.
Does that stay stable? Ideally you buy bonds with a hope that they tighten, their spreads tighten. To the extent that any kind of volatility and concern about, there's sort of a ladder effect here going down the ladder, which is, okay, we're here. If all of a sudden spreads start to widen over concerns that, the Fed's never going to ease, that a lot of these loans within the deals that I own, for example, are not going to be able to refinance. And if they do, they either go into default or the borrowers has to have great faith in that underlying asset, that they're willing to put more money in, pay down the loan, make it reasonable, doable. So from that perspective, I feel like spreads have been on the widening side, and they haven't been crazy. It's just, but it is that pressure. And so at some point, two things happen. If you own bonds and they widen, that's not a good deal. If you don't own bonds and you're buying spread deals, it's wider spreads, that's attractive, especially if you have confidence. And it makes it much easier to do that in a SASB deal where, the single asset, single borrower CMBS deal, such that, you're just focusing on hopefully perhaps one asset, right? One office building, one industrial property, whatever it might be. And in that environment, it's a more controllable situation as to say a conduit. So as you may know, the issuance in the conduit market has really fallen sharply. And
What
instead,
does
we're
that
seeing a
tell
lot
us?
of SASB.
What does that tell us
I
about?
think that tells you that the smaller borrower isn't feeling comfortable about, what they're doing in the conduit sector in terms of not any place, any smaller balance loan. We're not talking about, sub $1 million. We're talking, somewhere between 3 and, I don't know, 50, right? From a conduit perspective, and probably smaller than that. But to the extent that the uncertainty is really what's driving any kind of spread widening that we've seen. Frankly, if you're looking at a SASB CMBS and you like the underlying and you think the underwriting's is strong, then I think you'll see folks step in because those spreads are wider. Obviously from deal to deal, somewhat different, but there's been pressure for sure. And so to the extent that this is something that investors will look at the credit quality on the asset, if they're comfortable with it, if they're comfortable with the duration of the asset, they will buy that bond and they will, move forward, I think, continuing to do that. The conduit deals, in my mind, are an important segment of our market, and yet they're much lower in terms of issuance than is the SASB. The
A
other
conduit
side,
loan, just clarify, a conduit loan is?
conduit loan is multiple loans in a deal. So prior to SASB, there would be large loan deals that would talk about, and it'd be maybe 5 to 10 loans that were, say, 500 or 200 million apiece, or something smaller, but not conduits, which I think of back in the day of 3 to 25 million or something like that. So a conduit deal, I think, gives investors diversity. So you can have different asset classes, different size loans, different parts of the country. And so that was really the way the market started. And then there were something called large loans, where you might take 5 of those larger loans and putting them together. Today, you have one loan to one borrower, either collateralized by one trophy asset office, or maybe 5 of the same to the same borrower. So 5 offices. So the conduit market, in my mind, was a nice way to diversify your risk. On the other hand, you would argue that a SASB deal, say, an institutional office with strong ownership that's working today with long-term leases in place, that makes it easier to do sort of that analysis. And so you see a lot of folks buy those SASB transactions. Now, much of the SASB world was office and some malls, and yet office was a core. And so today, we're seeing a lot of those office loans getting refinanced, obviously, for those that work. And, in some cases, when you're not going to get the same sort of monies that you need in the first loan, you might have to just accept whatever's out there and then pony up there the rest of the capital. But to the extent that the SASB market has really usurped sort of that conduit sector as the core market in our sector, that's certainly true. I'd like to see it be more 50-50. And I think from a risk perspective, investors would like to see those conduit deals. I used to like what we used to call a fusion deals, would have maybe a 5 or 10 loans that are large, and maybe 100 million, 200 million, but not 2 billion. And then those smaller loans from 5 to 50 or whatever it might be. And so those were very diverse and helpful. We haven't seen any in a while. There's a couple, where you see the larger loans kind of creep up. But, to the extent, though, that the market is robust and investors are buying bonds. And I think that that's a good sign. Clearly, the uncertainty that's coming out of DC certainly doesn't help psyches, right? There's concerns about what's the next shoe to drop. Yeah. And, we just don't know the answers there. And I'm hoping that things settle down as we move forward. I don't think the Fed is going to move until, sometime, in the fall, if at all.
The next meeting is June, isn't it? It's like
that's the very next meeting. And, I don't know if there's not a great sense that they're going to move then. So that's kind of the challenge here is, when does the Fed move? I feel like in my mind, the inflation issue, unfortunately, driven by tariffs, is going to stymie the Fed from moving unless it's absolutely clear that that's what they need to do. And I'm not sure absolutely clear arises anytime soon. I just don't see that clarity coming.
What blind spots are most concerning to you now in CRE finance?
Like I said, I think malls have done well. There's some chatter that certain malls are not doing quite what they were doing. So that to me is just watch it, right? And if I'm buying a single asset, single borrower CMBS transaction, I'm going to look into that mall and understand who the ownership is, how have they performed in the past, because malls have been, like I said, they've kind of been in the spotlight for quite some time. Over the last 3 or 4 years, it's been more benign. And so I think you have investors who will buy those SASB transactions. But in terms of, what's some of the things that to focus on, I in many ways, the conduit deals, would like to see more of them. We want to see what they look like when they come, should they actually start to increase.
This
And you
is
want to
just for
understand what the
clarification.
underlying
Just for
collateral is.
clarification, this what you're talking about is liquidity in the market, isn't it?
It's liquidity, but it's also credit, right? I think the SASB deals, because they are so large, liquidity tends to be decent. Of course, liquidity tends to dry up a bit if there's any concern about credit. But the liquidity in the SASB markets are pretty decent. Because it's not like that conduit deal we used to have, a $2 billion conduit deal with 300 loans. There's a lot of sort of due diligence to do in that type of transaction. At least in a single asset, single borrower CMBS, you have pretty much all the information you need. It gets updated fairly frequently, and you're able to track performance and understanding. And it also will dictate, so today, an office building in a SASB deal, you really want to do your due diligence. You want to understand it. If it's in great shape, you have long-term leases in place to reputable tenants, you're probably feeling fairly comfortable. If you're a little less comfortable, then you're going to want to buy that deal at wider spreads and higher yields. So there is, I think, a lot of that going on. One of the things that CREFC is very proud of, and started well before I arrived at CREFC, is the investor reporting package. That to me is the sort of roadmap to the success of this business over the decades. The fact that you can look at an investor reporting package on a monthly basis and see what's changed on the collateral. And that's true for SASB, but it's also obviously more important for conduit when back in the day, you were tracking 300 loans. Today, conduit deals have become much smaller, and that could be sort of a somewhat downside, because the smaller the deal, generally the less liquid that deal is, right? It's in fewer hands and so forth. So, I think we're in a decent place, though. I would like to see, again, that conduit stuff really start to percolate a little bit and create more volume.
All right, let's move towards my final three questions, if that's okay, the sign-off questions, with one in particular. So you mentioned stagflation, and this is a very important topic. In fact, in Commercial Observer, you talked about the threat of an article about stagflation, where we see a cash flow declining for CRE while costs are increasing, and particularly this, interest rates staying where they are. You describe that as a double whammy. The Observer's headline is "Start panicking and keep freaking out." And the article opens with "Buyer beware."
Had nothing to do with me.
But would you agree? The article starts with "Buyers beware." We're talking about CRE, obviously, here.
Wait, specifically what on CRE?
Well, stagflation. I mean, the impact
on the asset
of
classes.
stagflation. Yeah, I'm kind of leading into my general doom and gloom view of the world at the moment, and just wondering what your view is realistically.
Realistically, my view is, this sounds trite, but in this environment, you shouldn't be doom and gloom, but you absolutely must be cautious. And you need to do more work than you've ever done, whether you're underwriting a loan for your balance sheet, underwriting loans to putting in deals, because you can be darn sure that, to the good, our investors, these institutional investors, are super, super smart. They do a ton of work on each of these deals. So they're doing sort of the re-underwriting on the other side. And so I do think that one of the things we all learned, GFC, people were just waving in, loans to close and then bonds to buy. And I don't mean to, I think the sort of reasoning for it happening was on both sides, right? Not to mention the macro markets were kind of crazy. But today, even with the current environment, it's still more stable than it has been recently. And so if you're buying bonds, you need to understand the underlying. And like I said, with a SASB deal, it makes it easier. But generally speaking, the real challenge we have today is the whole rate environment. The fact that, you have a coupon that's 3 or 4%, maybe 4.5%, that's going to 6 or 7, or 5, 6, 7, depending on the asset, depending on location, all of that. And that's going to make it very challenging for these borrowers to refinance and to do so without significant money into that transaction to sort of level it off a bit. So I do think from a macro perspective, the Fed strikes me as not really moving anytime soon. So that can still maintains that delta between what you're refinancing, what your finance rate is today, and what you're refinancing into tomorrow. And that to me is a significant issue that could cause delinquencies and the like to start to tick up. And
As indeed they are doing.
Right. Yeah, exactly. And you're only going to do that if you're 100% comfortable as an owner borrower that cash flow coming off the property is going to stay where it is or improve, because now you're dealing with a much higher mortgage rate. And again, that needs probably money in unless you've paid down the loan substantially, which probably isn't the case. And so those are the risks, I think, are considerable. From a bond buyer perspective, though, I would say underwriting remains pretty stringent. And that's a great sign. I think it's also a sign that shows a market that has sort of grown up in this sector. Folks, have been around a good amount of time. They've seen cycles, and they're underwriting loans in a way that protects not only the investor, but it protects their own businesses, if you will. And that's kind of the symbiotic relationship you really want in an industry like this. Unfortunately, outside influences are the most challenging right now, and that's the rate environment, that's demand for office, whether that ever returns to its past heyday or not. But I do think that we are also seeing a migration from the movement from older stock office, even slightly older, into new, and that's going to help that transition to some extent. What people say, it's a rate environment too. Basically to the extent that you want to move into a better building, you probably could do that today, based on what your sort of your money is at the original property, right? So to the extent that you'll see this migration from older buildings into newer, the one thing I will say is that while the sort of office to multifamily conversions sound like a great idea, they are certainly not a panacea. There are not that many sort of office assets that can convert reasonably without, again, expenses galore. And then you really have to make sure that works. I know that I recently attended a New York City event where they were talking about what's being converted. Most of it, though, is being converted to very high-end multifamily. And so that's a limited, New York City maybe not so much, but anywhere else, that's going to limit the ability to do those conversions in a way that makes sense.
Right. And you have to underwrite them to incredibly high numbers in order to justify even doing those kinds of conversions.
Right, exactly. It's super expensive.
Some big assumptions have to go into those.
Permitting and all of that. And I think New York is doing a good job of making that a little less cumbersome so that you see more of those conversions.
Lisa, let's roll into our sign-off questions, my rapid fire questions.
Oh my God, your rapid fire questions are pretty intense.
All right, well, I sent them to you, so hopefully they're not too intense. But this one should be hopefully. Anyway, I was on a funny call.
They're all good. I'm happy to talk about.
Oh, we're good. We're good. Okay. All right. So, first one, what are the 2-3 market signals you personally watch for that give you early warning of shifts in the industry?
Sure. First one would be just rates, 10-year Treasury and SOFR. Where that goes really makes a world of difference, right? And so it doesn't look like we're going to move substantially on any of that anytime soon, but any kind of sort of reduction in rate would be positive.
Okay, next, if you were advising a commercial real estate sponsor, right, the owner of a property, or an investor sitting on cash today, what would you be telling them to be doing in the coming months?
Okay, so first a borrower.
Borrowers.
I would say, don't forget, if you're to the good, if rates are rising and cap rates are higher, it means your valuations, all else equal, will be lower, right? So to the extent that I would say, if you're thinking of buying, now is the time to do that, right? To some extent, right? But you would rather wait until you see a reduction in benchmark rates and therefore mortgage rates. So there's that sort of right now. You also have higher cap rates, which means lower valuations. And so to the extent that you really kind of have to pick your poison, right? Your financing costs are going to be higher, but you might be able to buy that asset, at a reasonable level at some point. However, it's, to me, looking at the benchmark rates, it's really about the refi issue right now. I am just concerned that a lot of these loans are going to get extended, which is fine because it staves off the delinquency and it also allows the borrower time to refinance for rates to fall, whatever's going to happen. Clearly, we don't know the answers to any of those questions, right? So it's somewhat of a risk, and yet it's better than trying to take that or having to take that loss potentially right away. And so, yeah, rates are one thing. The other thing I look at a lot is not just loan performance on the CMBS market. I look at it from a balance sheet perspective. I look at the life cos, I look at the banks, and you see sort of collectively how this sector is performing. And what I can say to you, and from a CREFC perspective and a CMBS perspective, delinquency rates aren't anywhere where you think they would have been if somebody gave you the scenario that exists today. Right. So I think that speaks to a variety of things. It speaks to sort of just better underwriting and folks knowing in this environment with great uncertainty, you need to be conservative when you're underwriting these loans. They need to last whatever their terms are, 5, 7, 10 years on a conduit, and SASB, 5-year all-in floating rate. Anyway, I do think that it's rates, it's loan performance, what's falling, what's seeing, better, lower delinquency rates, what's rising in terms of delinquency rates. And some of the things that we've been watching too is multifamily is a general sort of from the GSEs, from the banks, the life cos, the CMBS market. I think what's also interesting that we haven't really touched on is the whole commercial real estate CLO market. Yes. To me, that is an important segment of this sector that has really increased in size, efficiencies, ability to reach investors, as well as tell and provide them with all the data that they need to make these kinds of investments. Because if you think about it, what are CLOs? They're loans on transitional assets for the most part. And so you have to have faith that those loans are going to be and those assets are going to stabilize. The CRE CLO gets paid off and a stabilized loan takes its place. So to me, that's a very cool new place to be. CREFC has spent a lot of time recently on trying to develop a reporting regimen that provides investors with all the data they need for a CRE CLO. It's not stable like, in a CMBS deal and a conduit deal, 100 loans go in, nothing else goes in after that. Loans can get paid off or come out. Whereas in the CLO market, you have that ability to manage. And, there are some static CLOs out there, but most of them are managed these days. What else? What other questions?
Last question.
Answer it all.
So, what political market developments are you keeping an eye on or anticipate could give you pause to rethink your assumptions about where CRE is headed?
Sure. That's a loaded question. There's, clearly anything that fans inflation, keeps rates elevated is a great concern because that affects everything. It's not just mortgage rates, it's capitalization rates. It's absolutely the whole 9 yards. And if you start to see rates increase dramatically, I think you'll start to see some degradation in just economic activity, right? So it affects everything. It affects your tenants. It affects about, how well occupied your assets are, your properties are. So yeah, to me, there's great risk in what happens, not only here in the US, but I think globally. We are more connected than we've ever been. And, but to the extent that you start to see economies like the US and other economies in Europe and elsewhere, and then also, if you think about economies, China, all of our tariff friends, I think that to me is the one unknown that could truly trip up lots of markets. And that needs to, the sooner that whatever is going to happen happens and we have all our negotiations and hopefully everybody ends up a little happier than they are today.
Peace on earth and prosperity for mankind.
So Anyway, that's, I think the issue is just, I think right now it might be more about global than it is, national.
Yeah.
So,
Lisa Pendergast, you are CEO, correct? CEO, Commercial
yes,
Real Estate Finance Council. What an enormous pleasure. Thanks so much for joining me today.
thank you. I appreciate it. Wonderful questions. We'll check.
All right, that was Lisa Pendergast, CEO of CREFC, the Commercial Real Estate Finance Council. Lisa, what an enormous pleasure meeting you today. I really enjoyed our conversation. I'm glad that you found the questions of interest. It was deeply educational for me, and I'm sure that it was for all our listeners and viewers as well. So I know how busy you are. Really appreciate the time that you spent with me today. And thank you too, dear listeners and viewers. Fascinating conversation, right? We're really digging in deep to what is making the world of commercial real estate work at the moment, especially in these tumultuous, uncertain times. If you've not already done so, do please subscribe to my newsletter, gowercrowd.com. You can always unsubscribe. You'll get detailed summaries of these conversations, the conversation with Lisa and others in this series, and occasionally some other insights. And if you've not actually already connected with me on LinkedIn, please go ahead and do that as well. I'm writing a lot on LinkedIn at the moment. You'll find me there on LinkedIn. Just search for my name, Adam Gower, or for Gower Crowd. I should pop up fairly easily. Okay, that's it. One more time, Lisa. Truly a pleasure. Thank you so much for your time today. I really did enjoy our call and our conversation. I look forward to following up with you perhaps later in the year to see how things change again. That's it for this week's episode. Thank you, everybody. And until next time, this is Adam Gower signing off.